Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. I'm Michael Bull, your host to the world of commercial real estate, where our topic today is the U.S. office market. If your company leases, owns, or invests in office space, or you're an advisor in the commercial real estate industry, you've certainly seen a changing office market. Well, today we'll get a look at the current market and what we might expect moving forward. Please welcome my first guest, Walter Page, Director of Research with the CoStar Group. Walter, thanks for joining us.
Thank you.
Well, Walter, to get us started, how did the U.S. office market sector perform in the first quarter related to rates and occupancy?
It was a good quarter. It's been a good year. Rents so far up 3.7% from 1 year ago. Net absorption is running at an annual rate of 74 million square feet, which is 20% higher than 1 year ago. And vacancy continues to decline at about a 0.4 of a point per year. We're right now at 11.9%. While the national trends are one thing, what we're seeing is a broadening base of the recovery. For example, out of our national coverage of 54 markets, 53 of those markets had positive net absorption for the past year. That's a 6-market improvement from a year earlier. Rent growth is expanding on nearly all markets. In fact, 50 out of 54 markets are now achieving positive rent growth. That's a vast improvement from just a couple years ago. And 15 of our markets now have vacancy rates that are less than 10%. And that's very important to investors since low vacancy rates drive rent growth and drive value growth. So overall, it's a good time in the office market.
Oh, that's good to hear. And how about across the asset classes? Is A performing better than B and C? What do you see there?
Overall, we continue to see a flight to quality. Tenants, employees want to be in nice space. Although we're starting to see some shift in demand towards Class B space, with the volume of Class B space net absorption for the past 2 quarters matching Class A space. Now, to be fair, Class B space, we have about 28% more of that than Class A space, so having Class A absorption matching Class B, Class A is still absorbing more on a percentage basis. So tenants still clearly want Class A space, but they're increasingly not finding what they're looking for, which is driving some new office construction or shift in demand to Class B space. The other thing that we're seeing across the Class A space is that rents are up. Class A rents, since the recession has ended, have increased by 7.5%. Class B rents are up 5.7%. Class C rents up 4.1%. Clearly, that reflects a flight to quality. Now, over a long period of time, we tend to see some substitution between the classes. So most likely, the long-run rent differentials between the classes will be less. But at the early part of the recovery, Class A has clearly done better in terms of rent growth.
Well, that's interesting. And those rate increases, is that pretty significant according to the trends you've seen in the past?
Significant, yes. I mean, we have not seen rental rate growth like this. I mean, we're at the highest point in rental rate growth across the markets by a long shot. And most of it is loaded towards the end. And those were cumulative increases. Most of that has occurred over the past year, however.
Okay. And what about the variations between central business district and suburban office properties, Walter?
So the suburban market is achieving an absorption rate that is double the CBD market on a percentage basis. This is most likely due to the strength of suburban industries. If you think about it, suburbs have a lot of the technology firms, energy firms, and healthcare firms, all doing pretty well. If you think about San Jose, for example, technology is in the suburbs. Apple is in the suburbs. Apple is not in the downtown market. In contrast, CBD-dominated industries such as government and finance, they're just not growing as fast as those other industries. That's the reason why the suburban markets are having a higher rate of net absorption. Now, while we're seeing higher rates of net absorption in the suburban markets, CBD rent growth is higher. 5.6% over the past year in the CBD market versus 3.1% increase for suburban markets. Now, this is somewhat being driven by over 11% gain in San Francisco and nearly a 7% gain in New York, but still CBD rents are growing at a faster rate than suburban rents.
Yeah, I guess there's so much demand there and not much product or new supply. And speaking of new supply, Walter, what do you see there? Is part of the reason for these rate increases the lack of new supply, and is construction starting to ramp up?
Construction is definitely ramping up. In fact, in-process office construction is up by 15% from 1 year ago. We now have 85 million square feet of in-process construction across the country in the major markets. At this point, new construction of office space that's in process is up by 77% from the low point in the recession. Now, it's isolated to a few markets: Houston, San Jose, San Francisco, Washington, and New York. But it's starting to expand. Recently, we've had new starts coming out of Seattle, Chicago, and other markets, as increasingly tenants can't find what they're looking for. Now, what we have been seeing in terms of new construction, the first phase has tended to be a lot of build-to-suit activity, but we're increasingly starting to see speculative development. And to give you an example, in the San Francisco CBD, they had a 60% cumulative increase in rent since the recession ended, far and away above any other market in the country. That has supported 2.5 million square feet of new office construction now underway in San Francisco, much of it which is speculative. Now, in contrast, I would say 2/3 of the office markets have rents that are less than construction justification. This has prevented new construction from returning to these markets. So until rents return to construction justification, or at least look like they will return to construction justification, we're going to see a limited amount of construction coming out of many of the smaller markets across the country.
Okay, and we're talking with Walter Page with CoStar about the office market. And so, Walter, what do you expect moving forward? If you look in your crystal ball, if you will, what do you expect for performance moving forward across the U.S.?
So for the office sector, we like to say that it's in the second half of the market recovery. And it's the part that typically is more liked by investors. In this second half, we expect increased rent growth in the 3 to 5% range, and rising construction activities, and continued vacancy declines, although we expect that to slow, especially by 2016, as new construction deliveries continue to ramp up. Since office has long-term leases, and many leases are below market, as these leases roll to higher rates, we expect office value growth to marginally outperform the broader market of, let's say, apartment markets, industrial, and retail. In addition, we expect to see a continued shift in capital towards the office segment, especially towards those markets that are trading at a discount to previous peaks.
Okay, and Walter, where do you see some opportunities, either asset-wise or geographically?
In our view, the best investment opportunities are related to improving a building in some manner. We would typically call this value-add or opportunistic type investing. For example, given that, for example, now is a great time to take occupancy risk. It's easier to lease up a building when the occupancy rates are improving than when they're not. And since occupancy rates are improving, it's just a good time to do that. The other thing that we see is there's a wide pricing gap between highly leased buildings and buildings that are not so highly leased. So the extent that you can buy things on the cheap as such and sell them at an expensive price because they're highly occupied, that is the opportunity. The other opportunity that we see is just buying what I call basis plays, or good valued properties that are selling for less than replacement costs. Most cases, this is focused on housing distress markets, such as Atlanta, Orange County, Florida, Phoenix, and also many suburban markets, close-in suburban office markets. We see that these are trading at discounts to replacement costs, offering investors upside.
Okay. Well, that sounds like some great opportunities. And Walter, we appreciate you joining us today. Thank you.
Thank you.
If you'd like to hear more from Walter Page, visit CoStarGroup.com. They have great coverage of the U.S. office market. In fact, all the sectors. They've also picked up their multifamily coverage, so check them out. Well, I'm Michael Bull. This is the Commercial Real Estate Show. Stay with us. We'll have more on the U.S. office market. We'll be right back. The Commercial Real Estate Show is brought to you by Atlanta Office Liquidators, new and used furniture liquidators, France Media, publications and conferences, Florida International University, Real Crowd, and Bull Realty Commercial Brokerage, a great place to do business. For more information on these companies or to access additional podcasts, videos, or blogs, visit commercialrealestateshow.com.